Some credit mistakes don't hurt at all. At first, your score stays fine. Applications still get approved. Nothing feels broken. But years later, those same small decisions quietly show up as higher interest, missed opportunities, and money you can never get back. In this video, we're breaking down 5 credit mistakes that seem harmless now, but end up costing you far more later than most people realize. Before we get started, if you want to understand credit before it becomes expensive, hit subscribe. This is where financial blind spots get exposed. 5. Only paying the minimum on your credit cards. Sure, your account shows current and your credit score isn't dropping. But here's what's happening behind the scenes. Every month, you only pay the minimum. Interest is piling up on top of your balance. A $2,000 purchase can end up costing you $4,000 over time. That's money straight out of your future pocket. Even worse, when you keep high balances on your cards, your credit utilization stays high. This is the amount you owe compared to your credit limit. Lenders see high utilization as a red flag, even if you're making payments on time. When you finally need a major loan for a house or car, that high utilization from years of minimum payments will work against you. You'll either get denied or pay way higher interest rates. The fix is simple but requires discipline. Pay more than the minimum whenever possible. Even an extra $50 or $100 a month makes a massive difference. You'll save thousands in interest and keep your credit utilization low. Your future self will thank you when you're approved for that mortgage at a great rate. 4. Closing old credit cards. This one seems smart on the surface. You pay off a card, you don't use it anymore, so why keep it open? Here's the problem. Your credit history length matters a lot to lenders. Closing an old card, especially your oldest one, shortens your average credit age. This can drop your score even if everything else is perfect. Let's say you've had a card for 10 years and 3 others for 2 years each. Your average age is 4 years. Close that 10-year-old card, and suddenly your average drops to 2 years. Lenders prefer people with longer credit histories because it shows consistent financial behavior over time. There's another issue too. When you close a card, you lose that credit limit. Remember credit utilization we just talked about. If you had $5,000 in available credit across all cards and you owe $1,000, that's 20% utilization. Close a card with a $2,000 limit, and now you only have $3,000 available. Your utilization jumps to 33% with the same debt. Unless a card has a high annual fee you can't justify, keep those old cards open. Use them once every few months for a small purchase and pay it off immediately. This keeps the account active and preserves your credit history. It's a simple move that protects your score for the long haul. 3. Ignoring your credit report. Most people never check their credit reports until they're applying for something important. That's a huge mistake. Errors on credit reports are surprisingly common. A paid-off account might still show a balance. Someone else's information might end up on your report due to a mix-up. Identity theft can go unnoticed for months or years. All of these problems damage your credit score and cost you money in higher interest rates. By the time you discover them during a loan application, it's too late to fix them quickly. Disputing errors can take 30 to 60 days or longer. You might miss out on a great interest rate or get denied entirely while waiting for corrections. The solution is easy. Check your credit report from all 3 major bureaus at least once a year. You can do this for free at authorized websites. Look for accounts you don't recognize, incorrect balances, or late payments you never made. If you spot an error, dispute it immediately with the credit bureau. Don't wait until you need credit to find out your report is a mess. Regular monitoring also helps you catch identity theft early. If someone opens an account in your name, you'll see it on your next check and can act fast. This simple habit prevents small problems from becoming financial nightmares. 2. Applying for too much credit at once. You need a new credit card for better rewards. Then you see a great store card offer. Oh, and that car dealership is running a promotion. Before you know it, you've applied for 3 or 4 credit accounts in a month. Each application creates what's called a hard inquiry on your credit report. 1 or 2 inquiries won't hurt much, But multiple inquiries in a short time send a signal to lenders that you're desperate for credit or taking on too much debt. Your credit score drops with each hard inquiry. Even if you get approved for everything, those new accounts lower your average credit age. Plus, lenders reviewing your application later will see all those recent inquiries and question your financial stability. This can lead to denials or higher interest rates down the line. The damage isn't immediate, but it adds up. If you're planning to apply for a mortgage or auto loan within the next year, those inquiries and new accounts will count against you. Lenders want to see stability, not someone who just opened 5 credit cards. Be strategic about new credit. Space out applications by at least 6 months when possible. Only apply for credit you actually need, not just because the offer looks good. If you're planning a major purchase like a home, avoid opening any new credit for at least a year beforehand. Your credit score will stay strong and lenders will see you as a stable, responsible borrower. 1. Carrying high balances, even with perfect payments. This is the big one that catches people off guard. You never miss a payment. Your accounts are all current, but you're carrying balances that are 50, 60, or 70% of your credit limits. Your score might be okay now, but you're setting yourself up for rejection when it matters most. Credit utilization is one of the biggest factors in your credit score, making up about 30% of the calculation. Lenders see high utilization as a sign you're living beyond your means or struggling financially, even if you're making every payment on time. When you apply for a mortgage or major loan, they'll question whether you can handle more debt. Here's where it really costs you. Let's say you're approved despite the high utilization. You won't get the best interest rate. On a $300,000 mortgage, the difference between a great rate and an average rate can cost you tens of thousands of dollars over the life of the loan. All because you carried high balances on your credit cards. The worst part is this mistake is invisible until you need credit. Your score might not tank, but it won't be competitive. When you're comparing loan offers with someone who has the same score but low utilization, they'll get better terms every single time. The target is to keep your utilization below 30% on each card and overall. Below 10% is even better. If you have a $5,000 limit, keep your balance under $500. Pay down existing balances aggressively. If you can't pay them off quickly, consider requesting credit limit increases to improve your ratio. Just don't use that extra credit. This single change can be worth thousands of dollars in better loan terms over your lifetime. Credit doesn't punish instantly, it remembers. Small choices stack quietly, and the bill shows up later when stakes are higher. The good news is that awareness comes early for those who look for it. Fixing mistakes now is always cheaper than fixing them later. If one of these mistakes sounded familiar, like, subscribe, and share this with someone who still thinks credit only matters when something goes wrong.